Hello, my name is James Matern, and alongside me today is Grant Harmon and Kevin Flynn. We will be talking about our portfolio optimization project. A lot of people hear they can make a fortune in the market, but they don't know about certain risks, and when their stocks go down, they sell them and lose their money in a panic. They are then turned off of the market for years and never get back into it. The truth of the matter is that if you invest your money smartly and invest in diverse stocks, you can manage your risk and have a better chance of success than the average Joe. There are ebbs and tides in the market, and people sell low and buy high, so this investing strategy is to buy the stock and hold it for an entire year. Many people try to predict the stock market, but they don't look at the right factors. Today we will show you how you can use risk management in your portfolio and still earn double what the market makes each year. The 10 stocks we chose are listed here. We wanted to create a diverse portfolio to help minimize the risk. To do this, we chose stocks from different sectors of the market. From the financial sector, we chose JP Morgan. From consumer defense, we chose General Mills. From the technology sector, we chose Amazon and Google. From consumer cyclical and food, we chose Chipotle Mexican Grill. From biotech, we chose Johnson & Johnson. From defense, we chose Boeing. From the industrial sector, we chose Caterpillar. From transportation sector, we chose XPO Logistics. And lastly, from the financial technology sector, we chose Visa. Variance is calculated by looking at the beta of each stock, which is a statistic that indicates how volatile a stock is. Beta values in the stock market range from 0 to upwards of 10 in extreme cases. The highest beta of a stock in the S&P 500, an index of 500 major stocks, is 3.8. So we used a range between 0 and 4 to determine what percentage the beta would be in terms of variance. To show an example, the beta for Amazon stock is 1.94. When converted to scale for variance, we get a value of 0.485. The expected value is calculated by comparing the current trading price of the stock to analysts' consensus one-year price target of the stock and calculating what percentage it is away from that target. To create the objective function of the code, we needed the variance and covariance of each stock, so we also calculated the covariance of each stock with each other. To do this, we used a correlation tool on Yahoo Finance, and then calculated the standard deviation of each stock in the previous year, and then calculated the covariance using these two metrics. Once we had both variance and covariance, we plugged these values into the Hessian matrix by taking the partial derivatives of each value as shown in the above written work. The average annual gain in the stock market is 7% per year. We decided we wanted to create a portfolio that doubles the gain of the general market. If our initial investment is $10,000 and we want to make 14%, our portfolio needs to make $1,400 per year. The first constraint is using the expected gains and how much we want to make in our portfolio. The second constraint is showing we want our stocks to add up to our initial value of the portfolio, which is $10,000. The last constraint is to verify that all values of the stocks are not negative. Once we had the objective function and the constraints, we plugged them into MATLAB to create our optimized portfolio using the quadprog function. Our results are listed here for all 10 stocks. The portfolio is optimized to minimize the risk, the variance and covariance, while still making $1,400 per year. As you can see, the optimized portfolio told us not to invest in any XPO stock. The reason for this is because the beta of XPO was the highest, so the variance was also very high. Because of this, the stock was too risky to include in the portfolio, and we were able to make the $1,400 per year without including it. The stock that our code told us to invest in the most is Google. The reason for this is because its variance was fairly low while still giving the opportunity for large returns. In conclusion, the market is not intuitive. If you have no knowledge of the market, one might just buy one or two stocks that have the biggest opportunity for growth to try to get rich quick. Unfortunately, this is not how to invest safely. The majority of the time, if you're trying to get rich quick, you will do the exact opposite. But if you have proper risk management, you can easily beat the market.